Many Canadians are facing financial hard times due to rising costs, with a significant number of people turning to loans for help. Joining us now is Peter Shashecki from Everything Financial. And so, Peter, a lot of people struggle with this one. Times are tough at the moment, and a lot of people are having to lean on loans. So what should they consider before doing that?
Well, one thing to look at, Reagan, is just because you're approved for a loan, especially in the housing market, just because you're approved for a loan doesn't mean you should accept the loan. Because sometimes that loan, and you think, well, I'm accepted, I can afford it. But many times you can't. It puts you in a tough financial position because loans, or the approval process of a loan, doesn't take everything into account. They take your debt service ratio into account, but they don't take all the other bills you might have into account.
Good to keep in mind. The other thing sometimes people don't consider are the fees that might be attached as well.
Yeah, there can be fees to loans and mortgages and everything else. So sometimes you get into them, but then what if it doesn't work and you have to get out of it? And that can be a problem. And there was an example of a lady who lost her car. It was repossessed. She really couldn't afford the car when you include all the other bills: childcare, health care, food. Apparently you want to eat too. And so she lost the car on a loan that really was out of her price range in the first place. But you think when you get approved, you can afford it.
And it can be so hard with inflation right now to budget for those kinds of things as well.
It is, especially too with what we saw in the last few years with interest rates. You're getting approved for a mortgage at this level, but then your renewal comes and interest rates go up. And we heard those stories about a lot of people where their payments on their mortgage doubled. So you were approved for a mortgage, say, that cost you $1,800 a month or $2,000 a month, and suddenly you're looking at $4,000 a month. Where's that money going to come from? And that's the problem with mortgages. You're approved for a total debt service ratio of all your debt on your credit score of 44%. You got to be under that. But again, what about all the other bills that don't show up? Childcare, healthcare, food, utilities, and so on and so on. You might have some other things, other bills that don't show up on your credit score, but they still have to be paid every month. So talk to a professional, go through a cash flow exercise, figure out what are my real bills, and you've got to make sure you have a good surplus available at the end of the month for the worst case scenario, the what ifs, the things you don't plan for, interest rates, the roof goes on the house, the heat pump goes, all these other things that can happen that could cost you hundreds to thousands of dollars in a month.
Mm-hmm. Scary to think about. On the note of car loans that you mentioned, how can a car loan affect your approvals for loans?
That's a great question, Reagan. If a car loan, a $400 car loan payment affects a mortgage by $100,000.
Wow, that much.
So if you need a car, but you also need a house or a condo, you still got to be able to pay for both. But when it comes to the approval process, you may want to wait to get the car until after you've been approved for the mortgage and get the house. But even then, still do the exercise. How much should I pay for the car? Because I still have all these other things to pay.
Definitely important to keep in mind. Yep. I didn't realize it had such a big impact.
It's a huge effect. It is.
And finally, to wrap things up here, any other things people should consider before taking on more debt?
No, I think it really is sound like a broken record, Reagan, but that's the cash flow exercise. Go through all the possible bills and make sure there's a significant amount left over for emergencies. You should always have an emergency fund. That's the one thing. You should always make sure they're there, but also make sure there's money for you. Pay yourself a little first before you start paying everyone else and the debt collectors. Make sure there's something there for a holiday or something. So even if you're 30, you're retiring a little bit. So having a holiday every year. Don't work for 30 years and then go, well, now I'm going to take a vacation. Do a little bit for yourself every year, or else what are you working so hard for?
Very true. Some good tips. Peter Shashecki from Everything Financial, thank you for joining us.
Thank you.